Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. I came across an organization that I thought was really interesting, and so I wanted to check it out. And I want to introduce you tonight to John Schell. He is the managing director at Social Capital Partners. He's got quite an impressive background. He's Ivy Business School, University of Western Ontario. He's worked in a couple of different small companies in Australia, as well as Canada. He's a co-founder of some business called Save Small Business. And now he is, as I mentioned, the managing director and partner of Social Capital Partners, and he has been there for 4 years and 10 months, almost 5 years. So, John, welcome to our show. How are you?
I'm good, Brian. How are you?
Tell me, what is Social Capital Partners?
Social Capital Partners is a nonprofit in Toronto, about 20 years old, founded by my partner, Bill Young. It was founded with the idea that, and this is not a controversial idea, but that the financial system works really well for certain people and really poorly for others. And Bill had done really well in his career, and he would say that a lot of that success was based on luck and being at the right place at the right time. And so he dedicated the rest of his career. He was in his late 40s at the time, and said, I'm going to spend the rest of my career thinking about how do we balance some of this luck? How do I use some of the skills that I've learned to shift the way the financial system works for more people? And so the objective of SCP was to try to reduce wealth inequality using financial tools that shift incentives in the private sector to create different outcomes. And so, over the years, we've done a number of projects. I guess the one that is most interesting, or at least the one that is most famous, and I use famous in not a real way, since there's really no fame associated with Social Capital Partners, but the one that people most know is a program where Bill would lend money to small businesses in Ontario in exchange for them hiring through the local community service agency. And a community service agency will generally try to find jobs for people facing barriers to employment. So whether they be single moms or refugees or people with physical or mental disabilities, like the list of barriers. And so they'll work with those folks to try to get them good jobs. And Bill would provide this loan to small businesses that required them to look at those candidates first. And if they were successful in hiring a candidate from one of those communities for a job in their company, their interest rate would go down by 1%. So it's something called social finance. It used finance as an incentive to shift outcomes in the private sector. And in this case, 500 jobs were shifted to people facing barriers to employment using these loans. What we also do is we try to de-risk some of these ideas so we can then scale them through partners. And so what happened then is we tried to use that program and work with the government and with several banks to pilot it in a way that could potentially scale across the province. That actually didn't work for lots of interesting reasons, but that's okay. We're okay with that. We're okay with ideas that are really interesting, potentially powerful, and sometimes don't work. And so that's the purpose of Social Capital Partners. I hope that makes sense.
I understand sort of his motivation for getting involved. Why'd you get involved?
Honestly, similar reasons. So the companies that the two companies that I've co-founded in the private sector have become the largest veterinary service providers in both Canada and in Australia. That has been that's worked out really well for me. I would say that a lot of why that's worked out didn't have anything to do with my level of effort or skill, but had to do with being in the right place in the right time as the financial system shifted, and largely because of my background, which is a background where I had access to things that many people don't. So I was in a similar position in my career, and decided that the world had overpaid me for my efforts to date, and it was time to try to do something else.
So you went to Ivy Business School. A lot of people think that business schools teach you that, capitalism is all about shareholder interest and shareholder value maximization. Why would you get involved in something that is about social capital and social good rather than just making money? I thought Wall Street told us greed was good.
Well, I would agree with that characterization of business schools, Brian. Happily, many of us go in with our own point of view and ability to kind of shift direction afterward. I think the criticisms of business schools and the criticisms of Wall Street are quite well placed. And a lot of action needs to be taken to shift the incentives that come from that shareholder mindset. There has been some change. I mean, I went to business school 20 years ago. I think there's been some shift there in trying to incorporate more societal concerns into the corporate world. I don't know how successful that's been. In fact, I would say it hasn't been super successful, with some differences, but there are opportunities to shift things. And in my view, this is the answer to how we shift things is not about, well, let's just trust certain motivations to create different outcomes. It's how do we work with the private sector? How do we work with the government to create different incentives that shifts behaviors automatically? And those things, they require effort. You have to do things to make that happen, and that work still needs to be done.
So you're investing your own and your partner's money. Do you take other people's investments into your fund?
So we don't, and we don't really have a fund. So we do two things. At least we're currently doing two things, and maybe I'll start there, because it might because we've shifted over the last couple of years to from a focus on jobs, which was the primary focus of Social Capital Partners for the first 16, 17 years, to a focus on assets. And one of the reasons for that is Bill and I sat down a few years ago and said, are we having the biggest impact that we can? Are we doing what we ought to be doing, given the fact that we can take as many risks as we want because we're independently funded? And our answer was, we didn't think so. We thought we were doing good work, but we thought there were lots of people who were focused on the income side of wealth inequality, but very, very few people focused on the assets or capital side of wealth inequality. And one of the things that we know about, one of the things that I think we've had a crash course in over the course of the pandemic, is that people who entered the pandemic with assets have actually done really well in the last couple of years financially. The people who entered the pandemic without assets have done really poorly. And so we decided to shift, and not because of the pandemic, but the pandemic just kind of showed why I think this makes sense. We shifted to the idea that actually one of the issues we need to solve is that more people need to own more assets in the private sector. And so housing is obviously the biggest example of that, but there's also business ownership assets. And so we focused on two things. So as we started to look into that, and I'll get to an answer to your question in a minute, but as we started to look into that, we said, okay, well, what are the best examples of ways in the private sector that have been proven to shift assets to as many people as possible in an accessible way as possible around the world? And we found something that frankly blew us away, and that's US employee ownership. And this is something we didn't know about before. But when we started looking into these things, we found that in the US, a very specific public policy framework was brought into place in the mid-70s. That policy framework has had bipartisan support since then. And its objective is to ensure that more workers owned a share in their company. And it was designed to help owners sell their businesses to their employees. And in that time, thousands of businesses have been sold to their employees, where right now there's 6,500 employee-owned companies through what they call an ESOP in the US, employee-owned companies that have 10 million workers who collectively in their retirement accounts have $1.4 trillion in wealth, an average of about $100,000 US, which is a staggering number. I mean, there are very few public policy interventions that have resulted in that widespread wealth creation. And so we said, okay, we dug into this, and we found there were two interesting problems for us to try to solve. One is Canada has nothing like that, right? We actually have no version of this. The UK brought it in 2014, so we can talk about that, but Canada has no version of this. So we need this in Canada. How do we do that? And the second is it could actually be bigger in the US. One of the issues with US employee ownership is financing. We can talk more about that, but there has been not enough financing available for conversions to employee ownership in the US. And when I say conversions, I mean, do you know the chain Publix, the grocery chain in the Southeast? So 200,000 employees, sort of like the size of Loblaw. It is majority employee owned. and has created millionaires from grocers and clerks. And you can imagine, the debates we've had, or the debates we've had over the last year about safe pay and the extra $2, and then they took it away. I mean, imagine if that had been employee owned during the course of the pandemic. You've got other names like Gore-Tex. What most Canadians will know is Bob's Red Mill. So on your shelves at the grocery store, when you get your Bob's Red Mill oatmeal, that's an employee-owned company, 100% employee-owned company, there isn't enough financing for this, right? The financing is normally done by the owner, and so we said, look, this has great outcomes. It would be a great solution for pension funds. Pension funds have all of this money that they're trying to invest on behalf of, in a lot of cases, labor, and this is a great asset class. Not very risky. They almost never go out of business, perform much better than their peers. Pension fund money could finance this. And so we set out to be a bridge between pension funds and employee ownership in the US. And so now to your question, we do invest our own money, and we try to partner with pension funds to invest in specific employee-owned companies in the US. The very first deal we did was we partnered with the Healthcare of Ontario pension plan, which is a $100 billion pension plan here in Toronto, to finance the conversion of Taylor Guitars, which is the largest manufacturer of acoustic guitars in the US. That company sold to their 1,200 employees last year, financed by us, a little nonprofit in Toronto, and the Healthcare of Ontario pension plan.
Fascinating.
Yeah.
We're talking tonight with John Shell. He's a managing director and partner at Social Capital Partners. He's got a strategy Social Capital Partners does that they can use financial incentives in the capitalist marketplace to help companies do things that are socially beneficial. He's historically been inducing companies to hire employees that otherwise would have challenges getting jobs. And now what he's doing is financing employee stock ownership plan companies. Fascinating. We're going to take a break for some messages and come back more with John Shell in just a minute. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. I'm chatting tonight with John Shell. He's a managing director and partner at Social Capital Partners. Social Capital Partners is an independently funded Canadian nonprofit founded in 2001, and their mission is to build a more resilient economy through broad-based ownership and quality employment. The current focus is increasing employee ownership in North America through both regulatory change in Canada and partnering with institutional investors to finance large-scale employee ownership transitions in the United States. Recently, they led the financing, as he mentioned, of Taylor Guitars, a transition to 100% employee ownership in partnership with the Healthcare of Ontario Pension Fund. This is the first time a pension fund has directly financed an employee ownership transition. Prior to joining Social Capital Partners in 2017, John co-founded the largest veterinary service providers in both Canada, Vet Strategy, and Australia, Vet Partners, and was a shareholder and board member of both companies until 2020. Before that, in the veterinary industry, he worked as a management consultant and once owned and operated a used goods store in a plaza in Central Toronto. He has a BA from Queen's University and an MBA from the Ivey School of Business at Western. As I said before, impressive resume. Thanks for joining us. So let's take a step back, and I'd like to come back and really understand employee stock ownership and what you're doing there. But let's take a step back for a second, if you could. There's been over the years a lot of talk about triple bottom line or the 3 Ps, or now it's ESG, which is environment, social governance issues. I interviewed a guy that is about corporate social responsibility, purposeful corporations, things like that. What do you think? Is there a reason why businesses should be involved in things other than shareholder maximization? And if so, why? And why would, so many smart people from the Chicago School and Harvard and Western be so focused on just profit maximization and shareholder value then?
So this is a extremely broad question that I think we could have a wonderful conversation about for a long time. I'll do my best to answer it quickly. I mean, the shareholder maximization is a relatively recent phenomenon, right? So that's sort of a mid to late 70s idea that came out of the Chicago School of Business, where the objective was to create this simple message that says, if we focus on this one thing, the business doesn't need to worry about anything else. And it's a bridge to us to, for them, it was a bridge to talking about regulations. It was a bridge to talking about taxation. And it was a different era. It was an era where there was some stagnation in the economy, a lot of that driven by labor issues, some of that driven by inflation, some of that driven by exogenous shocks, but it was a different era. And for very interesting reasons, that philosophy of shareholder maximization as the only objective of business. I mean, that was Milton Friedman's article. The only thing you should focus on in shareholder maximization, and that is what will benefit society. It's an absurd idea, but it took root, and then became a vehicle of public policy through, or Ronald Reagan and Margaret Thatcher became the vehicle for making public policy based on those concepts. But before that, it wasn't like that. Before that, you had companies who were deeply engaged in their communities. You had ownership that was focused on growing a successful business long-term, thinking about all of the different things involved in that. So R&D and what was happening in their local communities and ensuring that their employees were reasonably well paid. I mean, that wasn't 100% of the time, but there was more of an ethos of that versus shareholder maximization. And so, I think the economy was more successful also in that time, right? So 50s, 60s, very successful times for the economy. Now, this is something where you would have an argument against what I've just said for sure. But it's not as if business has always been focused on.
Okay. So let's give you a little bit of the argument just for a second for the fun of it. So,
Sure.
One of the criticisms was something called agency theory, and that it was management, spent a whole bunch of money and did things that shareholders might not like just for their own benefit because the shareholders weren't in control, and so therefore, they had salaries that were too high, or they invested in charitable things or pet projects or product things that were just of interest to them rather than profit maximization. And so one of the reasons why Michael Jensen and people, Milton Friedman, et cetera, wanted to have profit maximization as the goal was to rid companies of what they called this agency theory. The second was that they were proven right by a whole bunch of takeover artists that would come in and buy up companies that were wasting money and underperforming, with frankly debt that they would put on the company's own balance sheet. And so it was, they were buying the company with debt capacity that the companies had, were slimming the company down, selling off some assets, maybe cutting some employees, and making a ton of money. And so it appeared in the marketplace like actually that made sense to maximize the profit. So LBO artists, private equity people, et cetera, seemed to make a lot more money than the go-go conglomerate years of the 1960s.
So I would say, so your first one, agency theory, I would say, well, how's that going? I mean, ever since the objective of a shareholder maximization in order to reduce the agency of executives, executive pay has absolutely exploded. It is literally 100 times more versus the average paid worker than it was when the people behind the idea of agency theory came up with that idea. That's number one. Number two, by far, executives have their own pet projects now than they did then. I mean, you got guys like Jamie Dimon who'll decide, I'm going to invest $100 million in this, and he can just do it, right? No one even says anything. And so the idea that the maximization of shareholder value would reduce those things has absolutely no proof in what's happened. In fact, it's gone exactly the opposite way. So that's what I think of agency theory. On the second one, which is the idea that people, made a bunch of money in LBOs. Yeah, it also created a massive debt crisis, and drives both companies and economies to challenges of resiliency that we are seeing now in the supply chain issue, right? I'm forgetting his name now, but he's a very famous Canadian professor, Roger Martin. Roger Martin wrote a book recently about this exact issue, where the driving force behind maximizing efficiency was making our economy incredibly fragile. And that fragility has been repeatedly tested and has not been up to it, right? We have seen consistent crises. And so every time you're trying to get the exact right capital structure, you are driving your company to an incredibly fragile place. And what we have seen, that companies have not been resilient. So absolutely, financial actors can become super wealthy through these activities, right? I mean, you know, one of our arguments is that you now see among the richest people in the world, so many of them are fund managers, where 50 years ago they would have been entrepreneurs. And that makes no sense to us. The structure of economy that allows financial actors and financial engineers to end up with most of the spoils of the economy is not how you ought to structure an economy. So I would agree with you that the idea of shareholder maximization invites a ton of financial engineering that results in massive windfalls for certain people. But that's not, I don't think, good evidence that it's a good idea.
Okay, good comeback. And just to state the numbers, and you probably know this really well. In the 50s and 60s, 67 to 70% of the market cap of the Dow Jones was industrial companies. In the 80s and 90s, that same proportion was financial actors, financial companies, banks, et cetera. But today, it's technology companies. So,
or at least it was a couple months ago.
Yeah, finance did take over for a while, big time. But technology has taken over in the last little while. Yeah,
I mean, look, you make a strong argument that there's a lot of finance behind a lot of these technology companies, but sure, I mean, the issue isn't whether financial companies are the beneficiary; it's where financial actors are the beneficiaries. And so I would group venture capital, private equity as financial actors who are largely benefiting from the rise of those technology companies. Now, look, this is not to say that nothing is good and nothing works. And this isn't to say that profit is bad. Profit is not bad. This isn't to say that the market is bad. The market is good. The rationale behind what we are doing at Social Capital Partners is to say, and I think the rationale behind what a lot of people are talking about in the economy today is that capitalism is not one thing, right? It is a spectrum of things, and different companies do it in different ways. And each country has done it in different ways over many years. The US being the biggest example of that, where it's gone back and forth between different versions of capitalism. And the objective ought to be to figure out what the right balance is.
So the couple of years ago, the big thing was this triple bottom line. And in the last, probably 2 years, it's been ESG that you hear all the time. What do you think about ESG?
Look, I think thinking about those objectives are good, right? I think that if you are, and I think that the critical thing is striking the right balance between saying we're going to, that's going to happen because companies are now focused on it, versus a good combination of companies trying to act in the best interest of the planet and governments trying to act in the best interest of the planet, and those two things working side by side. We need to have some version of a regulatory system and some version of good acting on the part of companies, and the two things hopefully will be enough. Our view on on ESG specifically, there is a lot of focus on the E side, right? So the environment. There's a lot of focus on the governance side through diversity and inclusion. Both of those things are good. There's very little focus on the S, the social outcomes. And we would say that employee ownership, to bring it back to that, is one of the only real things one can do to achieve on the S side. I mean, the S is like minimum wage, et cetera. Most of it is government regulations, but what can happen on the corporate side is more employee ownership does result in better outcomes for workers.
Okay, we're going to take a break for some messages and come back. And I want to understand exactly what these employee stock ownership plans are all about, what the regulatory change is that you need to put in place, because if it makes sense in the United States and it's worked well, and you're financing company buyouts for employees in the States, why can't we do it in Canada? And it sounds like, frankly, it's a plank that maybe some politician should run on. We're going to take a break for some messages. We're going to come back with John Schell in just a minute. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. I'm chatting tonight with John Schell. He is managing director and partner of a organization called Social Capital Partners. Really quite interesting discussion we're having about what the role of corporations, businesses are in the economy. And John is of the opinion that companies shouldn't be just interested in profit and shareholder value. They should be interested in doing something more. But he doesn't think that ESG or triple bottom line or conscious capitalism, I think was one of the words that was bandied around a little while ago, and things like that is the way to go. He thinks it's employee stock ownership. And what you had said is that a regulatory framework was put in place in the 1970s and 80s in the United States to allow employee stock ownership. I actually remember reading, I think it was about Levi's, that was sold to an employee-owned group, and that they used that as one of the examples of how you actually got better work and more quality. And that was kind of interesting. Tell me, what do we need to do in Canada to incentivize employee stock ownership?
Sure, and I will say that I think it's great that companies are thinking about those things you described: consciousness, purpose, all of that. All of that is good. But in addition, we can do other things to be supportive. So in Canada, we have employee ownership, a few different types of employee ownership. I mean, we have stock options, we have purchase plans, we have worker co-ops, and in the US and the UK, they have those things too. What we don't have are these employee ownership trusts, which is a vehicle for the transition of companies from an owner to their employees, which they have in the US, as you discussed, and as they now have in the UK. And the UK is a great example. They brought these in 2014. And now, I think last year, something close to 200 companies will have transitioned from their owners to employees. But we don't, again, like I say, we don't have that here in Canada. There's a great case to be made. So when you say politicians should run on this, I agree with you. There's a great case to be made on why you'd want to do this. These companies in the US have been studied very deeply over the 50 years that they've been in existence. And we know four things about them. We know one, and this is the most obvious one, they increase employee wealth. So employees at ESOP-owned companies have 92% more wealth than employees at equivalent companies. Recent studies have shown that those effects are even higher for women and people of color. Two, we know it's great for economic resilience. So employee-owned companies survived the 2001 recession, the financial crisis, and are now showing that they're surviving COVID better than equivalent companies for lots of reasons, including incentives, right? I mean, the incentive of the company is to keep going because it's the employees that benefit. Third, it's great for succession. So, in Canada, we are facing over the next 10 years a wave of retirement among business owners. Those companies are going to need to transition. This is a great tool to have for succession that we don't have today. And the fourth is these companies tend to stay where they are. So if an owner wants to sell a company and it's bought by a competitor, jobs will often leave that community, even though they might have been there for decades. These companies don't tend to leave. So these are great for local jobs and great for Canadian ownership, right? Because again, now these companies are staying Canadian. So there's four good reasons for it. And it's actually been reasonably compelling in that both the Liberal Party and the Conservative Party have shown support for this. The Liberals put this in the last budget in Canada and said, we are going to study what are the barriers to these types of trusts in Canada and why don't we have these today? And in the last election, the Conservatives put this in their platform that they will bring in employee ownership trusts in Canada and provide appropriate incentives. So we feel really good about where this has gone over the last couple of years. Engagement with politicians has been terrific. They've been really interested, and so far reception has been really strong. We also had the CFIB. We were very lucky. They put out a poll of business owners who said if these policies were put in place, 53% of the people who responded said they'd be more likely to sell to employees if that were the case. One thing that's really important about these, which I should say, is this isn't a transition to employees from a governance perspective. Employees don't run the company in these examples. What happens is the ownership of the company moves to this trust, which now owns the shares of the company on behalf of employees. And so over time, the financial benefits of the company will now flow to employees after the owner's paid out, but the company will continue to be managed the same way It always has been. You imagine a company like Publix that I talked about before, 200,000 employees across several states, many locations. You can't run that like a co-op. It has to be run in sort of a more traditional or hierarchical way.
But the employees, I presume, elect the right people to run the trust, and the trust elects the board.
Yeah. So the trustee is appointed. There are many experienced trustees in this, and yes, the trustee elects the board. The board governs the company. It's exactly like that.
But the employees, if they own shares in the trust, must have a way of choosing who that trustee is that's going to manage the trust and elect the board. So they've got, if not direct control of, they've got influence on the board. Do they not?
They don't. So the way these work is the trustee is actually appointed prior to the employees even knowing that this is going to happen. Let's take the Taylor Guitars example, which is one I know really well because and the owners of this company, Taylor Guitars, by the way, are wonderful. So they're very involved in conservation of wood and very thoughtful about the areas in which they're involved. And so they decided to go down this path. And as the deal comes together, the employees don't know it's happening, because if it doesn't work out, nobody wants to then tell the employees, okay, now it's not happening. So all of the details are put into place beforehand. And then after the deal is done, the owners will then announce to the employees, this company now belongs to you. And that's what happened in the case of Taylor Guitars. And so then every year, the employees will get a certificate that says, here's how many shares you own, and here's what those shares are worth.
Okay, but they're not giving they're not giving it for free, are they? There must be.
They are giving it for free. So there's two incredibly important things about these, and this is why we love them. So one, employees are given the shares for free, and they go to all employees. So unlike most other forms of employee ownership, this isn't for senior management. This is all employees who work, sort of at least part-time in the company. Usually they set a bar of 1,000 hours, get shares, and the shares are given for free. And the reason why that's possible is because these are debt financed. These are debt financed vehicles. So on day one, the company has, the shares are worth zero, right? Because whatever the company is worth, the company owes. But as those shares get paid down through cash flow, share price goes up.
Okay, but a typical company can't raise debt equal to its full value.
The owner provides that debt, right? So in the case of Taylor Guitars, for example, they were able to raise about half of the debt required to finance the transition, and they provided the rest of the debt themselves.
And so what's the benefit to them? Do they get to delay capital gains tax or something?
Yes. So there's generally, so well done. There's generally tax incentives associated with this. So in the UK, owners don't pay capital gains tax if they sell to their employees. And in the US, they can defer and potentially eliminate capital gains tax if they sell to their employees. So there's the four public policy reasons I mentioned before for doing this. Have incentivized American politicians, both Democrat and Republican, to continue to make these more beneficial in order to incent more of them as you go. In the U.S., if you're an employee-owned company, you don't pay any corporate income tax. So Publix, for example, pays no corporate income tax, and that's the benefit for them being owned by their workers.
So if they don't pay any corporate income tax, they're worth a lot more money, and so does that value increment of effectively enjoying pre-tax earnings rather than after-tax earning accrue to the prior owners or to the employee owners?
To the employee owners. The employee owners. So the value to the previous owners is set, right? When the deal happens, right? So they get paid out. They're done.
So the government,
all of the incremental value.
So the government, let's say something is worth $1 billion. Company's worth $1 billion. And so the government, number one, is giving up tax over time on the earnings that $1 billion corporate tax on that earnings that $1 billion company would have been paying. And number two is giving up the capital gains that the prior owners would have paid on that $1 billion company sale. Is that correct?
It is now, and what they recoup in the end is now those shares recycle. So those employees, when they retire or when they leave the company, have to pay tax on the gains of their shares. So there is a new form of revenue now available to the government through the now repeated sale of shares over time.
And do they have to sell those shares to other employees, or can they sell them in the open market?
Company buys them back.
The trust.
Yeah. So the company, all the company cash flow now goes to, it's not, you make long-term investments, and there's a lot of great alignment throughout the company now, but most of that company cash now goes to pay out employees who leave. So that's the purpose of the corporate tax reduction in the U.S. is to preserve a cash flow to be able to pay out employees when they leave.
So this is a fairly sizable commitment in cash by the government as an inducement for employee-owned companies. Do you think it gets a return for that?
Yeah. So in the UK version, for example, there is no a corporate tax reduction, and we don't have a strong view. The only strong view we have is that the capital gains tax exemption makes sense. The capital gains tax exemption, we believe, is substantially offset by the new revenue that they're going to receive from employees who now gain from their shares and then pay tax on those gains. So, in our view, over time, we don't believe this to be a significant commitment on behalf of the government.
And I guess the reason why is you believe that this employee-owned company, number one, as you say, is going to be earned by employees, and those employees are going to make wealth that they otherwise wouldn't have. But then also, in addition, the company now employee-owned is going to be more interested in doing socially good things for the community, for the products, for the product markets, et cetera.
Yeah, I mean, look, think of the 200-person manufacturing company in a smaller town in Canada that now stays in that town forever, right? Continues to employ people from that community. The proceeds of that activity now flow to members of the community, when the risk is it gets bought by a competitor or a financial player and is devastating potentially to that community. One of the great examples of an employee-owned company. So it is very difficult to do this in Canada today, but it's not impossible. There are a few companies. Ellis Dawn is a great example of an employee-owned company. One I particularly like is Friesens in Altona, Manitoba. Very small town just north of the U.S. border. 600 employees, been employee-owned for 50 or 60 years. Have had to jump through an enormous number of hoops in order to make that possible. But has been a wonderful member of its community and will continue to be a wonderful member of its community for decades. And there's no risk to that, which is why governments love this, right? Now you can talk about permanence of local jobs and good jobs in local communities through programs like this.
And you wanted to compare this to management buyouts, where just the top executives own. And some people have criticized leveraged buyouts of their governments giving a huge incentive to the LBO artists because interest is deductible against taxes and dividends aren't. And so therefore, when you lever up like crazy, you're getting an implicit benefit from the government. What do you think of that?
I think there are lots of good arguments that there are too many incentives for financially engineered leverage buyouts. I think there's a lot of good arguments that that's true. One of the nice things about this is there is a lot of leverage in these, but the owners of the leverage are just a different type of owner, right? In this case, the owners of the leverage are the previous owner, who has obviously a lot to gain by ensuring that the company survives. They don't do anything like take a bunch of profit out in some sort of dividend recap. They don't have the ability to do those things. So if you're going to use debt to buy out a company, it'd be much better if it was this way.
Fascinating. Do you think there's a chance that the Liberal government is going to implement this? It's a minority government. If they and the Tories both agree, should get done.
We're hopeful. It's not the easiest policy in the world. There's a lot of complexity to it. We know they've been working on it, so we feel good about that. We feel like it's not just the Conservatives and the Liberals. I mean, this has generally been a very progressive policy as well. So, in the U.S., from Bernie Sanders to Ronald Reagan, have voiced support for this policy. In the UK, it was brought in a coalition government. So much like the minority government we have today, with support from their four major political parties. So we're very hopeful. It's the kind of thing that makes a ton of sense, that people like when they listen to it, but it's not the kind of thing that people generally, write something on a sign and protest for. So you really need people to believe in good, smart, proven public policy. We have talked to politicians who have said this is good, smart, proven public policy. And so we're really hopeful it gets done.
Well, John, thank you so much for sharing this with us. If people want to check out more about Social Capital Partners, is there a website they should go to, or a Twitter feed they should follow, or how do they find out more about you and what you're up to?
Well, this one, we have a website called employee-ownership.ca, which we think is pretty good for this. We do have a Twitter handle. I don't know what it is. I've been there, but then socialcapitalpartners.ca is our website. But maybe I think this goes on YouTube. I'll put it in the comments. Or I should know those things. I'm going to get better at that.
Real pleasure chatting with you tonight. I happen to believe that employee stock ownership makes a ton of sense. I've actually written a paper on it, and I wish you well, because I think you're doing good for people and you're doing good for the economy. Thank you very much.
Thank you, Brian.
That's our show for tonight. I remind you, I'm on every Monday through Friday at 6 o'clock on 960 AM. You can stream me online at www.saga960am.ca. And we have always interesting interviews with people just like John Shell at Social Capital Partners. Thanks for joining us, everybody. Good night.